Hello, my friends. Brett Pattison coming at you from the financial capital of the West, the North Salt Lake City.
North Salt Lake City.
Joined by the chairman, Brian Hunsaker. How we doing, Brian?
We're doing good.
It's been a while.
It's been a while.
You're out, I'm out, you're out, I'm out. But I'm glad we finally get to sit down and talk about a great subject. A subject that a lot of people have asked about that we do a podcast on. So before we get to that, what that subject is, let's hit where we are year to date.
Sounds
right
good.
now, year to date, the S&P is up 14.14%. So 14%. The NASDAQ is up 34, almost 35%. That's a pretty good year.
Really good year.
For both markets. Trailing 12 months, S&P 500 up 1.56%, and the NASDAQ up 7.96%.
I probably shouldn't ask this, but what's the Dow up this year? Do you know?
I don't even track the Dow.
Yeah.
Don't even look at the Dow.
Yeah.
It's irrelevant. You know?
Yeah.
S&P, NASDAQ, Russell.
It's irrelevant when it comes to an index, but it is interesting because the Dow does capture a kind of a different, market. And I know it's lagging severely this year. The S&P and the NASDAQ. Yeah.
Yep. And our clients, I think our clients know their returns year to date and trailing 12 months. So I'm sure they'll be pretty happy with the comparison. But we have come off the highs quite a bit. Not quite a bit. That's not fair. But at one point, the S&P 500 was up 20% on the year. Now we're up 14%. So it's come down a little bit, which is to be expected. As you know, Brian, I like looking at history of the stock market. And August, typically, probability-wise, is the second worst month of the year in a normal calendar year. Guess what the worst month is?
Oh, you just told me.
I told you. September.
I know, yeah.
September is the worst month. So the volatility, the up 20, now up 14% makes total sense.
Yeah.
If you look at coming off of a bear market, new bull market, and just the historical nature of bull markets. Makes total sense.
It makes sense. And it also makes sense when you think about the psychology of markets and just here in the U.S., it seems like we start out the year with optimism and hope for a new year.
Yep.
Then summer comes and
the summer doldrums.
And that's what we go through. And there's not a whole lot happening during the summer. And then we get, a lot of people get back from summer vacations and things, and they start reevaluating their portfolios.
So that's why September's the worst month of the year, because after Labor Day, you get all your portfolio managers home from their lake houses or wherever they are.
Right, yeah.
And they clean house in September, getting ready for the last quarter of the year, which blows my mind.
Yeah.
How people and hedge funds and these portfolio managers clean house. It makes zero sense to me.
Mm-hmm. But
you said earlier, well, they're window dressing.
Yeah.
What do you mean by that, these portfolio managers?
So investments, every quarter, money managers have to report on their holdings.
Yeah.
And also they get their clients get quarterly statements, and September's the end of the third quarter of the year, and September 30th, and their window dressing basically says that portfolio managers are trying to make their portfolio, look better. They're going to they want to sell their losers, buy more of their winners. So he bought this, this stock's done well.
Yep.
And which is kind of silly, but it does happen.
Well, that's why September is the worst month of the year, because you get these portfolio managers. I can just see it. The 13F is what it's called.
Yeah.
That Katie knows all too well, right? 13Fs, and they report the changes to the portfolio or what they've done. And we research these quite a bit. find new ideas and see what others are up to. And I promise you, in October, after this third quarter, we're going to see as these portfolio managers clean house and the market continues to pull back a little bit, we're going to see new AI plays.
Yeah.
Because that's the hot thing.
Mm-hmm.
I better put that in so my clients think I have AI.
Right.
And all that kind of stuff. It's dumb.
It's silly.
It's dumb.
Yeah.
So expect more volatility over the next couple months. It's normal. We're not worried about it. In fact, we're excited about it, which leads us to the topic of today. We've addressed fear a lot over the last, ever since we've been doing this podcast.
Mm-hmm.
We've had, last year I think was the biggest bear market that we've had, the longest bear market, and we talked about fear. What to do when the market's falling. Don't sell, buy.
Mm-hmm.
But we've never addressed fear in a rising market. And so that's what we want to talk about today. The S&P 500 was up 20%, and it brings up another fear.
I mean, before we get into that, why do we talk about fear so much?
Because it causes people to do dumb things.
Yeah.
And it is an emotion that all of us have, right? We're hardwired to have fear in our lives.
Yeah, absolutely.
And to act on that fear, whatever that may be.
And the psychology aspect of investing is, you wouldn't think it would, from an outside point of view, you'd say, well, what does that matter? But it actually plays a big role in the success of investors.
Yep.
And unfortunately, and it usually plays a role that really detracts from investment performance. And that's why we talk about it a lot, because people allow their emotions to take control of their financial decisions, and that's usually a mistake. And that's why we talk about it a lot.
Nick Murray, one of my favorite authors or portfolio managers or writers, whatever you want to call them, in our world, says behavioral finance is the key to making money.
Yeah.
To not interrupt the compounding effect of your money. So when we talk about fear on the upside, you're 100% right. It's because of that behavioral finance, that psychology. But there's a fear that has an acronym, and I want you to explain this acronym. It's called FOMO.
Mm-hmm.
What does FOMO mean?
Fear of missing out.
What does that mean?
Just it means that you're fearful of not getting great investment returns. You see the market going up. You talk to your neighbor next door. He says, "Oh yeah, I bought Microsoft or some stock with its AI, so it has an AI association. I bought it earlier this year and I'm making great money." And so the guy says, "Well, I don't want to miss out on that. I better go buy it." And not to pick on Microsoft. We love Microsoft, but
it's any stock. It's Meta / Facebook.
Right.
We still call it Facebook. Yeah. Nvidia. It's the market up 20%. It's when that happens and somebody is sitting on cash, there's a fear that they will miss out.
Yeah.
I've already missed out on 20%. I'm crap.
It's a natural thought process when markets are going up to want to participate, want to jump in. Usually it's a lot of times you're jumping in after the market's gone up a lot, and vice versa. There's the same tendency when markets are going down. We didn't most people aren't calling us last year and saying, "Hey, I want to buy, even though we talk about that all the time, that when markets are down, that's usually a great opportunity to buy great businesses. But again, the psychology
Yeah.
Most people aren't doing that.
And when you think of FOMO, recently there's been, you could say FOMO 2 years ago, 3 years ago in SPAC investments, FOMO in cryptocurrencies, and FOMO, if you invest at the wrong time, can be very detrimental to your creation of wealth. But when you're talking about the market as a whole at 20%, how would you address FOMO for people? Or what would you tell them if they said, hey, market's up 20%, I've got all this cash, I'm missing out. What should I do, Brian?
I'd say send us the cash and let us follow our process.
Which is what?
So those that have listened to this podcast know, but those that are relatively new, and we'll remind you, but our process is really a 4-step process of how we put money to work, how we invest clients' assets, how we invest our own assets. We always tell our customers that we eat our own cooking. What we do for you, we are going to do for ourselves.
Which we do.
If I was the customer, this is how I'd want my money managed. That's ultimately why we started Iron Gate 20 plus years ago, is to apply this process. But it's a 4-step process that we've learned from great investors. One of them is Warren Buffett. This is a process that we've copied and kind of adapted to our own approach. But the number one principle that we utilize is we don't invest in anything we don't understand. We think that's a really smart thing to follow.
If you don't get it, don't invest.
I mean, just think about it. If you don't understand something you're investing, it's probably a sure way to lose money.
Then the risk is twice, three times.
Because you don't understand why you own it.
Yep.
So if it goes down, you're more likely to sell it, even though that it might be right, but it may be a mistake. You don't know because you don't know anything about it. So it's a big mistake. Number 2 is we try to identify companies and businesses that have durable competitive advantages. Durable meaning long-lasting advantages. And again, you think about the opposite, doing the opposite, investing in businesses or investments that don't have competitive edges. That looks like a sure way to lose money over time.
Enhances the risk even more.
And then the third thing is we look for managers that run these businesses that are smart, that are honest, that we trust. You think about investing or having managers of a business that you don't trust, that aren't smart, that aren't honest, that don't work hard. You don't want those, you don't want those people. No. So that's logical. And the last thing is price. What is the right price to pay for a business?
So the first 3 we identify, then we sit on it and we don't do anything until this 4th one is in place.
Yeah.
And that 4th one is, state that again.
It's price. And so what we do is we calculate and we look at a lot of data, crunch a lot of numbers, and do a lot of thinking about a business. You and I were talking about a business yesterday. We've been talking about it for months and months and months about this business. We haven't pulled the trigger. We're still, in fact, I was just listening to an interview with the CEO just a minute ago, trying to determine if it's a portfolio that, first of all, has all those 3 characteristics, but then the last one is price. Now, the price is actually crossed over where we think that it's an attractive price, but we're just making sure that those first 3 principles were right on that. So we think about these things a lot. And like I said earlier, we're also investing our money alongside. If we decide to invest in this business, we're investing our money alongside yours. So we're very careful about that.
So the 4th one, price. About 3 weeks ago, we had maybe 2 stocks in our buy range. Mm-hmm. Now we've got 5.
Half a dozen maybe.
4 in our buy range. As the market pulls back, which it oft times does, that allows us to
put money to work.
And so our process is very simple. We research, we analyze all month long. And then the last week of the month, we look at the investment opportunities and we put money to work on those businesses that we want to buy, including the one you were talking about that we haven't pulled the trigger yet, that we're close, that we may or may not.
May or may not.
And so that's what we do. The market up 20% in a year, that's a good return. That probably won't provide as many opportunities as the market down 5% or 10%. Right? We're almost market agnostic. We don't care. It's, hey, when this business is on sale, we're going to buy it.
Right.
That's the discipline.
Yeah. Yeah. We just follow our process, follow our discipline.
How boring is that?
Well, it's boring, but it works.
Yes.
I
mean, I trade options. That's but it's all based on the same stocks that we're analyzing and the same prices and everything. So it's all.
And you have a process too when it comes to options. I mean, it has to meet certain criteria before you do it. Otherwise, you walk away from a trade. It has to.
Returns and probabilities and price that we want to buy and all sorts of stuff.
And so when you're buying a business, you want to pay a low price. So if you have money, if you have cash, you'd rather pay, on a stock, let's say it's trading at 50 or at 60. I'd rather pay 50 for a stock as opposed to 60. If I can, I'd rather pay a lower price. So having the market down, and if you have cash, is not a bad thing.
It's not a bad thing.
And I'm mostly invested. I mean, I have, personally, I'm not. I really don't sit on a lot of cash. I put it to work. If I have cash that I'm not going to need for the next several years, I usually invest it. I mean, I always invest.
Always invest it as your process dictates.
But with the process, with the process. So, and when we talk about price, the last thing on our list, price is, take some number crunching. We're looking at the balance sheet. We're looking at the income statement, the revenue. We're looking at historical numbers. We're looking forward to trying to understand the business. What will growth look like? What will future profitability look like, say 3, 4, 5, 10, 10 years down the road, and saying, what's a fair price for this business based on, what this stock has done in the past regarding profits and what it will look like in the future. And we come up with what we call intrinsic value. And we want to buy that business at a discount to its intrinsic value, the fair value of that business.
And what's required? One characteristic that's required to be disciplined. And if a client comes in and says, hey, the market's up 20%, why am I 30% in cash? It's a darn P word that we all hate. And it ends with patience. It's patience.
Yeah.
And that is so hard when you see the market going up. But we know we've built Iron Gate on it, which is if we're patient and we wait, and it's not that we won't adjust our buy range, because we will, but we follow our process and people will accomplish their goals.
Yeah, just be patient. I mean, if I would, if somebody's interested, they could look up our 13F, it's a website called Whale Wisdom and type in, I think you have to type in
Amazon
Hunsaker, but if you type in Hunsaker, you'll find our 13F and you'll see our portfolio, and you'll see when we bought the stock, our average cost basis, approximately. These are estimates, but you can see that we are patient investors.
We're not window dressing, is what you're saying?
We're not. I mean, we're absolutely not. We're buying businesses. We're being patient. And if I have a client come to me and ask, that same thing, well, I got 30% cash and the market's going up, say, just relax. We're in this for the long game, for the long term.
Yeah.
And a few months here and there is not going to ultimately make a huge difference. And so just be patient with us. Markets go up, markets go down. Over time, they go up, but in between, it's like a little yo-yo guy walking up the steps. He's got a yo-yo. It's like following that yo-yo, but ultimately the market's going up over time.
From lower left, upper right. So in a bear market, when clients are fully invested, right? Because the buying opportunities are there in the market.
Why am I fully invested?
Why am I fully invested? Our response to them is be patient. You're going to be okay.
Yeah.
In a market where it's very, very bullish. Why am I not invested? The response is
Be patient.
be patient.
Always be patient.
We'll get you there.
That is a very key ingredient to success when you're an investor, is patience.
Yeah. So to the FOMO, to the fear of missing out, psychological, I don't know what we want to call it, barrier or obstacle. How do we overcome that? It's that P word.
Yeah. Let me just mention one thing. Yeah. I had a client call me earlier this week, and he's hearing from, so-called experts, which we predicting a market correction, predicting, a bear market. We heard a lot of that. In fact, at the end of the year, after a bear market, you actually hear more of that talk. But now the market's, it's not making all-time highs, but some stocks are getting close to all-time highs. You start to hear the same sort of thing a little bit, saying, "Oh, the market's near a high. Prepare for the next bear market." And I would, I just think that it's silly to listen to these people. They're always out there. It's like, some guy on the corner that's screaming to the top of his lungs every day, and every once in a while the guy's right. And so
even a broken clock is right twice a day.
Twice a day. So I think it's silly. I've heard them for the last 30 plus years. Yeah. I've gotten accustomed to it, and I just ignore that. And that's been a very good decision, to ignore these guys, because they don't know what they're talking about. They absolutely don't know whether or not the market's going to correct or not. They were predicting big corrections at the end of this last year, 3,200, even more. Yeah, 3,200. Okay, were they right? They've been absolutely wrong. So they absolutely don't know.
So here's an interesting statistic. After a 20% decline in the S&P 500, bear market, that's a bear market.
Yeah.
The next bull market, on average, over the next 24 months, has at least 5+% pullbacks / corrections. They're going to come.
Oh, yeah.
That's just, we're seeing it right now. People jump on it then and then try to freak you out. There's fear on the other side that, hey, you better go in cash because this is coming to a head.
This is when these guys start yelling a little louder.
Or selling annuities.
Yeah, exactly. when this happens, this is when they start yelling a little louder, like, hey, it's just starting, beware.
So fear on both sides. Fear of market crashes, fear of missing out on good returns. Brian, what do we do?
You ignore it and be patient.
Patience. Yeah. Hope that helps. If there's any time where you feel that FOMO feeling or fear of the market crashing or whatever, feel free to reach out to us. We're happy to jump on the phone. And I always say, and so does Brian and Spencer and everybody else, part of our job is that of financial counselor, right? Meaning, hey, we'll counsel you through good times and bad. Psychologist, call it that. Coach, whatever you want to call it.
Yeah.
Be patient.
Be patient, and don't get too hung up on short-term numbers. I mean, you got to think about it in, I always think about 3, 5, 10 years from now, and I feel very good about our portfolio looking to the future, long-term future, couple years, 2, 3 years from now. I feel very good. And so I remain optimistic, and I love our portfolio. I love the businesses we own, and that's what you need to focus on.
Yep. 3, 5, 10 years requires patience.
Patience.
Amen. Until next time. Bye now.